Welcome to Crack the Code, a show that aims to cut through the clutter and inform and educate you into becoming a smart investor. I'm Sarabjit. This week, we turn the spotlight on the healthcare sector. The industry covers a wide gamut of businesses, be it hospitals, pharmaceuticals, medical equipment, insurance, and diagnostics. Today, we'll focus on the pharma space.
The $17 billion Indian pharmaceutical industry is one of the fastest growing sectors in the country. It has become the third largest market in the world by way of volumes and 13th largest in value. It's a rather unusual setup compared to the rest of the world. There are 20,000 registered units comprising organized as well as unorganized players and MNCs. Of this, 250 large units and 8,000 small-scale units control 70% of the market share. India also has the distinction of being the hub for low-cost drugs. Little wonder that it has emerged as the largest exporter of generic drugs, which stands at around $12.7 billion. 20% of the world's generics in terms of volumes have a Make in India label. But the scene on the hospitals front is not so pretty. India has less than one doctor and bed per 1,000 people, way below the World Health Organization standards. Though this segment is seeing much action with the entry of private equity players, a lot of ground is yet to be covered. Although, there's no denying that the growth opportunity is huge.
On that positive note, let me introduce you to our guests, Sarabjit Kour Nangra from Angel Broking and Surajit Pal from Prabhudas Lilladher. Thanks very much, guys, for coming out here to our studio. And, this is a sector that actually not a lot of people have understood very well, right? But I want to first start off by what's so unique about this sector. Surajit, the pharma space has outpaced the Sensex, right, since the index itself was established. What is the reason for this? Is it just the defensive nature of the sector, or is there more to why it's so attractive for people?
I think the real run-up has happened post-2009 when there is a global fiasco has happened. So I think overall nature, even the global investment houses, is that they want to keep a certain percentage definitely on defensive sector. So pharma was one among them. And rightly also what happened at that point of time is that 2009 onwards till 2014-15, a hell of a product went off patent, and that has helped most of the Indian companies to grab that opportunity and grew.
Okay, so is it just that they got a good time to get in, found something that was available at that time? But Sarabjit, like I said, this is a sector that not a lot of people understand. I mean, me included at times, right? So you have generics, you have patents. People don't even know the difference. Okay. So if you were to explain the sector to a layman in just 5 key points that they should look at, what would they be?
In a layman's term, if I have to look at a company, I think you should look at this sector as any other sector. And if I have to look at 5 pointers that I would look at it, is probably I will start with the management, because the quality of the management, like any other business, plays a very big role in how the company shapes up in future and rewards the shareholders. The other factors is a product portfolio, and which would mean that they should have a basket of products where they can have good profitability from the products. Another area which pharma is very well known is R&D. So in terms of, to put it in very simple language, what is generic and what is patent? Generic is something which the manufacturer doesn't have any right on the IPR on the product, whereas patent is something where the seller has an IPR for the product that he is selling. So most of the Indian companies, they are not into the patented part of the business, they are into most of the generic part of the business. So their R&D spend is more towards generic segment, not the patented one like the MNCs do most of the time. So these companies you have to look in terms of R&D, where they're spending, which niche segments they're spending, which segments which will be profitable in future. So that's one area. So these are the couple of, I think, 2-3 pointers that I look into.
Okay, so the opening up of an R&D center is always good news then.
Yeah, it is. But obviously, like any other investment, it should be productive. And it should be yielding results sooner than, normally R&D takes longer time also. So commercialization to the market should be faster.
Okay. Surajit, what should an investor look at while entering? I mean, Sarabjit's laid out some of the points. And also, are there any triggers for exiting stocks in pharma companies?
I believe it is very tough to say, these are the benchmark where you could get it. But I would say from my perspective is that at current point of time, if you look at next 2-3 years, you should go for that kind of pharma or healthcare sector companies where risk from US and to a certain extent domestic market is less. Because
is there a pharma company like that?
Yes, there could be diagnostic sector, there could be healthcare sector. I think these are the areas where you will get better exposure than the any fine morning NLEM comes out with another 50 products and the company has only 3% in the restricted list, becomes 15% of the restricted list. So it is, even the most knowledgeable guy cannot predict it.
One key factor which you can keep in your mind while exiting a stock or whether to decide whether you have to exit, one is in case these developments are not structural for the company, and these developments will not have a long-term effect for the company developments, and secondly the valuations at which the stock is trading, because I believe if the structurally nothing has changed in the company and the valuations are decent enough, then it doesn't make a point to exit the stock.
So within this whole basket of what collectively forms pharma, what are the sub-sectors that investors should focus on?
Given healthcare, has a lot of sub-segments like hospitals are there, diagnostic centers are there. You have recent lots of IPOs coming in diagnostic segments.
And successfully.
And you have API manufacturers. So there is a lot of ancillary space which is available, along with the listed pharma generic players and the MNC players. And I think most of these segments will do well. But the best one that we think will flourish in terms of cash flow and its requirement of investments is diagnostic, because it's a cash business. It's one segment in pharma wherein you require very less investments and the churn out rate is pretty high. So the profitability of the business is very high, and it's domestic business, so it has less risk in comparison to other large caps which have different markets to cater to. These are just domestic companies as of now. But then again, as I said, for an investor, the moot point is after you have identified the moat in the business, you have to look at the valuation, what price you are paying, because price is something, if you don't buy at the right price, you end up making less wealth for yourself. So the valuations are the key, and I think that space is currently, even though it's high growth, the valuation, I find it a bit stressed given that the demand supply is for such a paper is right now very high. So I think though the business model over there is pretty attractive, I think investors need to play that space also cautiously.
Okay, that's a good point actually, because the show after all is focusing on value investors. But what about you, Sarabjit? What's the sector that you favor, the subsector?
I think there are very few equipment manufacturers, so better take it pharma, pure pharma, and then get into diagnostic and then hospitals. I think out of these three, or if I subsegment over there, my preference in the sector is that the top of the level where risk is minimum and return will be much better with very good cash flow. I think diagnostic sector is one, and CRAMS focused on NCA business like Syngene. So I think they are the top of the echelon. And if I go for the second one, then I would say you should be more on CRAMS or biosimilar, where you have already proven R&D areas like Biocon. Might be valuation could be stressed, so you can take the benefit of any kind of market correction, and companies like Divi's. The point with the Divi's is that Divi's is a good percentage of business also focused or dependent on generic partners. Healthcare space like say hospitals, I think you better go for a hospital which is bit of niche, not much dependent on bed or something like hotel type business, because turnaround for their investment is much better cash flow. From that perspective, I think HCG is better option. They are not dependent really on bed, rather than the repeat of the customers' visit to their centers. So I think mindless expansion for any kind of hospital business just to increase their prowess in the sector is really not gel with the value investment. Rather, you should go and invest in new hospitals with your own money.
Okay, so let's get talking about companies then, right? Let's start with Strides. They sold their cash cow Jilla for what was 3 times their revenue. They gave a dividend of 500 rupees, right? Then came Bafna. Now it's Strides Shasun. So Sarabjit, in just the last few years, there have been quite a few corporate developments here. How does an investor actually look at not just this particular company, but what's the takeaway in general?
See, takeaway is that definitely the pharma is a wealth creator. We have seen it across a lot of M&A that's happening in the industry. So when it comes to M&A and when such developments happen, obviously any investor has to go back and see whether it makes sense for them, or whether these acquisitions are in terms of going to add to the profitability of the company, or they're going to dilute. Because sometimes happen that management in the sake of growth, they acquire companies at valuations higher than they are justified. So that deteriorates the ROEs of the company. Okay,
so Surjit, how do you look at all of this M&A activity? Because off late there's been a lot, right? There was Sun Taro, there was Daiichi Ranbaxy, then there was Sun Ranbaxy. How do you think investors should look at this kind of M&A activity?
A bigger company does more mergers and acquisitions, and the basic purpose, whatever they say, the bottom line is that they have to grow. For example, Sun Pharma with $5 billion of sales, with a normal 10% growth is $500 million. In generic business, $500 million expansion in a year is very, very tough. Even Pfizer could not do it with $5 billion size. So even you see Pfizer or any big guys like Teva, like Mylan, like Allergan, Actavis, everybody wants to acquire more. They want to grow more, because the normal generic business cannot give them a growth which they used to give 10 years back. So 10 years back, you could not see much of mergers and acquisitions, which for size of Teva, for size of Sun, is definitely is one of the requirement to increase their top line and the EPS. So that is the main purpose. Second purpose is that sometimes it is strategic, they do, but those kind of strategic acquisitions are smaller, niche. So I prefer that kind of acquisition rather than the big acquisition.
That makes sense, actually. But let's talk about also some of the smaller companies in this space, right? Because there have been quite a few multi-baggers. Say an Ajanta Pharma, for instance. You know, even somebody mentioned Oro Pharma to me a few years back, and you know, people wouldn't take it seriously enough. And these are stocks that have actually turned out to be big value creators, big wealth creators. What's the idea for a smaller company? What should investors look at to help them actually spot these kind of multi-baggers much before their time has come?
See, one is definitely management capability, their vision for the businesses, and their timely execution of those vision statements that they put up internally to and to outside world in terms of achieving their targets. That's one that you have to track. And secondly, definitely in terms of generic, one parameter you can put in is R&D investments, because that's where their pipeline comes out of in terms of whether it's domestic markets and more so in international markets. That's one parameter you can use to gauge whether they are building a pipeline which gets commercialized in the next few years. Then is there obviously the market share, the positioning, and their product basket, which can give them growth higher than the industry, so then they can become leaders going tomorrow. So Aurobindo in that case has been one company who had been spending a lot in terms of R&D before they become a bigger company, because they were building pipelines, they were investing in manufacturing facilities. So these are a few triggers which you can, or pointers which you can look in a company and figure out whether they are poised for good times or bigger times ahead.
Okay, my next question is actually on a lighter note, right? So a lot of these homegrown companies, you have Dr. Reddy's, Cipla, Wockhardt, these are all Apna Indian companies, right? So how do they stack up? Desi versus MNC, what's the call?
My call, or my understanding of so many years in this sector, is that MNC guys are really very less, except to a certain extent Glaxo. Where I found out is that they wanted to be Indian, to grow in India. And the biggest problem with MNC guys is that they still have a hangover of, we belong to the big company and we have some snob value. And we are not bothered about generic product. For Indian guys, we sell only cough syrup, vitamins. I mean, you see the last 15 years of their portfolio. So that is the attitude. That's why they could not grow. As an investor, you should be more on Indian companies, because they have that zing, always trying to, it is a hunger they have, how to grow, how to outgrow the others. So they don't have the luxury of being snob.
Let's get to this US FDA business, right? Because given the nature of our companies and the exposure to the US market, that's a problem that keeps cropping up time and again. Are all observations very extreme? I mean, how should a US FDA inspection be looked at? What are the points for an investor to actually get worried? I mean, what is a 483? Break down this business for us, both of you.
483 is nothing but when US FDA inspects a manufacturing facility, which happens on a very regular basis, because that's one of the regulatory requirement of the US, that the products getting imported in the country, and there the manufacturer has to get his manufacturing facility audited by the US FDA, which is a regulatory authority in the US. They're very stringent about the quality of the products, the way the quality controls are happening in of the products, the manufacturing facilities. What is 483? Basically, to simplify, it's just an observation from the US FDA when they inspect the facility, and then they list down the list of observations which they find is deviation from their requirements.
It's not as extreme as it's often made out to be, because even an import alert can be temporary in nature, right? So for a value investor who's looked at a company, say all things being equal.
By now, most of the Indian companies have a track record of handling such events. So you should, one, go by track record. This is just a safety, for your safety. Second is, in case one plant gets into inspection, whether it has a backup in terms of products getting supplied from the other plants, or it has a backup where its revenue and profitability in the meantime when the import alert is going on doesn't get impacted. So to give you in case, though I don't track that company in very much detail, is Vocard. It's taken a hell lot of time to come out of the import alert and still is struggling with many issues over there. When you buy a pharma stock, you have to look at management quality, the diversification in terms of manufacturing facility, diversification of revenue, so that it's not highly just dependent on US markets, because obviously it's an event risk which is playing out very often.
Sarabjit, what are you making of this whole news on price control for drugs? I mean, is that going to be a big setback for companies for their volumes?
Most of the times what it happens is that it is one of the champion product of most of the companies where they are getting the major revenue. So what the big guys are doing is that wherever they have a large product, champion product, and the price has come under restriction, so they want to go for huge volume rise. So what happened is that the guys who could not afford it previously now can afford it. So he may not be taking, for example, say cheaper product. So he might be going for the champion product in that particular category. So they want to capture that. So that is where the situation comes, where they want to grow more volume. But ultimately it's a zero-sum game. If he increases volume, the other guy's volume decreases. So overall sector-wise, definitely it's a negative. From investor perspective, it's a negative. And what I observed is that whenever you have some products under restriction list, the companies are doing practice is that the non-restriction list, they increase the price like nobody's business. And ultimately those products also comes under the restriction list. So that is the game, and I believe that given the recent alacrity of our regulators, Indian market, it is not going to be dissipated soon. So it will continue. So I think 15%, 16% kind of overall sector growth may not be possible for next 2-3 years.
Okay, so just to wrap it up then, what's the advice for investors? Is there any big trigger that they should look out for in the coming years? What would be a good opportunity for them to enter the pharma space if they haven't?
If you look at the potential that Indian pharma has, we spend hardly 4% in terms of our on healthcare, whereas US internationally it's more than double for developed countries. So potential is there. I can't rule that out. Definitely, growth is there. So most of the Indian companies are well equipped to take the advantage of that growth. So as I said, these events are common for the industry players. So you have to choose and pick stocks or companies which are well equipped to handle these challenges, and you have to buy them at right price. So that's my advice to investors.
I think my view is not that positive about the sector, and I believe that number one, generic business, the pie of the generic business pool is very much shrinking, and whatever the product has been there, there will be a lot of competition from day one. Size of those products are very small, and most of the Indian large companies have billion-dollar sales plus. So the growth on US market is really questionable. Plus, structural wise, US FDA and Indian regulators are very cautious and very alacrity, as I said. Third point, Indian companies are delayed in terms of putting money in R&D. So that is going to pinch you in your EBITDA margin. So that will increase by 300 to 500 basis over next 2 to 3 years. The result of it, unlike generic product, I think very uncertain, because we don't know how many of them will be succeed at the end of, because ultimately for you and Merck and Lilly and Pfizer on the same space, because you are fighting, it is unlike generics that, you know, the pharmacist will push your product. So you have to convince the insurance guys, you have to convince the doctors, you have to convince the end users, and then ultimately you get success. The Indian companies has very few success in last 15 years. I think 2-3 products, all the 3 products fortunately belongs to Ranbaxy, which is no more. And so I think this is the basic scenario. So they are getting into a patented period where they will be fighting with this product. A lot of money is spending out of that. And Indian guys to churn out new product in Indian market is also very limited, because your normal organic products are no more. It is all biotech product, so you have to come out with a biosimilar. So unless until you have a cash, you'll be simply distribution partner of Mylan or say Pfizer in India. So future is not that rosy for small, for big, for large.
So life as we know it is practically over, and there's everything new that's on the horizon.
Yes.
Thanks very much, Sarabjit. Thanks very much for joining in and for actually breaking down the pharma sector for our viewers. All right, so that brings us to the end of this show. Do stay tuned as we continue on our quest to decode and analyze so that you can invest wisely. Until next time, thanks for watching.